Welcome to the Invested Dads Podcast, simplifying financial topics so that you can take action and make your financial situation better. Helping you to understand the current world of financial planning and investments, here are your hosts, Josh Robb and Austin Wilson.
All right. Hey. Welcome back to the Invested Dads Podcast, a podcast where we take you on a journey to better your financial future today. Josh, we are going to be creating a stock draft for the remainder of the year, or really about 6 months.
Yeah, stock draft. That's where a stock gets really close behind another stock so that the wind resistance is in there.
Well, that's kind of funny because Formula One starts on July 5th, is the Sunday of the July 4th weekend, I believe.
Okay, yeah.
And there's drafting involved there.
There is a lot of drafting.
And after all of this COVID business, my life has been without racing largely for, 4 months. So it's time. Let's get it on.
NASCAR's going.
I mean, real racing is what I'm talking
racing
about here. No offense to our NASCAR fans.
It's not real racing.
So anyway, that is the wrong kind of draft. Today, we are going to be creating a fictional account for each of us, and we're going to see who picks the better stocks. So, ground rules.
Rules. All
Josh,
right.
take us away.
I like rules. All right. So this is going to be hypothetical. No real money involved.
Dang it.
We're going to each have $100,000.
Really dang
Yes, I know. I wish we did. $100,000 to invest. To make this simple, we're going to invest in 10 stocks.
10 stocks.
Each stock has to be in a different sector, and we're going to use GICS sectors for reference point.
Global Industry Classification Standards.
Yep. And so that means you'll have 10 stocks from 10 sectors. Now there's more than 10 sectors.
There's 11.
There's 11, so you can choose which one to leave out.
Ooh, I like power.
So we'll buy stocks today, figuratively. So we're going to use the end of yesterday's price, the 25th.
625 close.
So the close of 625 is our starting point.
Yep.
No trading from here forward. We're just picking 10 stocks, and then at the end of the year, we will see who did well. So 10 names, 10% each.
Yes. 10 names. You're banging on the table.
That's me hitting the table.
Yes.
I was wondering what that noise was. It was me.
So 10 names, 10 different sectors.
Yep.
You're choosing not to hold one of the sectors.
Yes.
Here are some other rules. No mutual funds, no ETFs, no cryptocurrency.
He didn't say no closed-end funds.
Oh, I did not. Well, it is. Mutual fund, a closed-end fund is a
you're
mutual
right.
fund.
I just teased it.
There's open and closed. So no crypto, no commodities, no precious metals directly of any of those. Mm-hmm. No options or derivatives.
Can't do the 2 times leveraged, 3 times leveraged.
triple leveraged oil ETF.
Yes.
Actually, there's a triple leveraged NASDAQ ETF. That's
probably
been
up
been doing really
20%
well.
20% or something.
Highest total return as of the close on 6/25. We're going to do it through Christmas, so it's exactly 6 months.
12/25, yeah.
Yeah, or that's what I meant, 12/25. 6 months from our draft.
Okay.
Wins donuts. So the loser buys the winner donuts.
That sounds good
Now,
to me.
Josh, briefly, we actually had an episode about this, which we'll throw in the show notes, but briefly describe total return.
All right, so total return is what it sounds like, the total return, meaning everything included. So the other option would be price return. So the difference between those two, price return does not include dividends or any kind of payout to the shareholders. Total return does. So if you choose a stock that pays a dividend, we will count that at the end as part of the return.
Correct. And that will not be reinvested in any way, shape, or form.
No, we'll just add that as a payout. Yep.
Okay, so here we go. First pick. Josh, I will let you have the first pick. And I forgot to say, another rule is we can't pick the same names.
Yes, you cannot. So once it's gone, it's gone.
Once it's gone, it is gone, which means there's slightly more than 10 names trading on the stock market.
We should be all right.
We should be okay.
I don't think any sector has only one company
that
in
would be
so we should be
funny.
Okay. So it's kind of like when you do a fantasy draft for football, if you remember what football was before COVID-19.
Wait. So we can do a 2-person snake draft?
We'll go back and forth. But you got to say, like, do I pick my linebacker first or quarterback?
know.
So here we go. I'm going to start by saying kind of my mindset and kind of what my thought process was. Is one of the things that we believe in here is invest in what you know.
Yeah.
And so I kind of thought, okay, not all these companies I know of. I had to look them up because I'm not familiar with some of these. But I'm going to start with one I know, all right? And I'm going to go with, and I'm actually going to skip past my first one because this is the one I want. Fiat Chrysler.
Oh, yeah. You're a Jeep
because
Chrysler
they make
guy.
Jeeps.
Yep.
And so I own a Jeep Wrangler. I like Jeep Wranglers.
In your van.
And so And I do own a Chrysler Town and Country van as well.
Yeah.
And so that's going to be my first pick is the Jeep.
Okay.
So it's, I don't know what category it's a
That would
staples,
be
cyclical.
consumer discretionary.
Discretionary.
Probably.
Okay. This
So-
was consumer cyclical on the thing I print out, which is a different sector classification.
Well, we will double check that sector
I had
classification.
it discretionary.
So, okay.
That was the category I was pulling it out.
That's good. So next, my first pick, invest in what you know. I'm picking Amazon
Amazon.
because
Good choice.
I just think that they are doing an incredible job and taking market share. And it's an amazingly run company. They're diversified and just, I get, if you invest in what you know, I know Amazon because I order from them at least once a week.
Oh, yeah.
So those little brown boxes or white envelope packages, they're always on my porch. So Amazon off the table as well.
Sounds good. I'm going to follow that up with Microsoft.
Microsoft is your tech pick.
That is my tech pick. I like them, and that is also one of my, I'm going to call it a defensive play.
Yeah.
If COVID comes back, I think that one will do well if people are working from home and will continue to shine. Now, I did see they were on some news today. We're recording this on the 26th, Friday, that they're closing a lot of their stores.
All of their retail
Yeah.
operations, which
I'm indifferent to that.
do you really go to a Microsoft store?
Yeah, no.
So Microsoft off the table
Yes.
as well. Yeah, that is a diversified play as well because you get hardware, you get software is the big thing, and you
Yep.
get cloud,
Yep.
which is another reason I like Amazon with AWS. So my next pick, I'm going to follow it up with another tech pick as well. I'm going with NVIDIA.
NVIDIA.
NVDA is the ticker. They make the best graphics chips that you can own.
So, yep, good chip company.
So, I mean, they're like the Frito-Lay chip of computers.
And you're in a good kind of cycle of renewal with the 5G coming
Yep.
out, and there's a lot of new hardware. So
And with
good
they
call.
make the artificial intelligence chips, the gaming chips, the autonomous vehicle chips. I just think that it's going to be a good play for me.
Good call. I'm going to go from one of my more defensive pieces with Microsoft being pretty stable to go with a kind of a hope
Okay.
guess here.
Okay.
I'm going to go with Delta, which is an
Delta,
industrial.
Yeah.
So Delta Airlines is obviously an airline, and I think if the recovery happens, they've been beat down really hard. There's a chance for some recovery there. So that's the hope that we don't see a second round during the 6 months during the stock picking time frame.
Now that is my favorite airline to travel
It's
on.
mine as well.
I feel like the planes are clean and well kept, and I like everything about it. So
You know what
good
I like
pick.
about it is
You're-
the onboard entertainment for kids.
Yeah.
It's free. They have movies, and it keeps kids entertained while you're
No,
flying.
that like 2-hour flight to Florida is a blink when your kid has a little movie to watch or whatever like that. All right. Well, I am going to pick my consumer staple pick for the day. I am picking Dollar General.
Okay, that was on my list. That was a good
And
one.
you see that, so I'm not from Findlay. I work in Findlay. I live in Findlay. Findlay's a big city for me, but it's really not a big city. But I'm from a very small town, and I drive through a lot of small towns to get to my small town where my parents live. And I see Dollar Generals popping up in every small town on my way there,
Yep.
which is insane. And Findlay has like 3 of them. Or
Oh,
something.
yeah, it's crazy.
insane. So I'm going Dollar General because I just see a theme.
Yep.
And I think that there's going to be some traction there. So Dollar General off
Good
the
choice.
table.
All right. Well, if you're shopping at Dollar General, I'm going to shop at Target.
Target. People
Target.
love that place.
I mean, I know my wife, anytime we're traveling, we don't have a Target here in Findlay. Anytime we travel to any city that has a Target, somehow it's on our agenda to stop at Target while we're there.
whether you need something or not.
It's just crazy. So Target, which
like Costco.
is, and that's a consumer defensive, according to my
Yeah,
thing.
that'll be a
Or
consumer
staple. Yeah.
probably play. Yep.
Yep.
I am going to pick a healthcare company.
Ooh, okay.
And I'm
Healthcare.
going with a healthcare company that's diversified and it's pretty well known. I'm going to pick Johnson & Johnson.
Johnson & Johnson.
J&J, they're stable. They've been around for over 100 years. They're doing really well, and they have some feet in the water for the COVID-19 vaccine treatment.
There you go.
Or, vaccine. So I like that is a part of it, but I also like that's not all the company is about, so they won't be as hopefully volatile. It's pretty stable.
All right. For me, I'm thinking through, I think what I'm going to pull is real estate,
Real estate.
and I'm going to go with American Tower. I knew. That's why I wanted to grab it. I thought that might be on your list.
That was on my list.
So American Tower, they're a real estate company. They own the towers that cell phone companies, they use for their signal. And so they rent or pay.
Yeah, so like Verizon would lease
the tower to get their signal across. So with 5G coming out, there's more demand as constantly more and more people are using smartphones. I'm doing American Tower.
That is a great play. I should have drafted it one earlier, but I did not. So good job, Josh. American Tower. Oops, I am going to go with. There's a couple holdings that I'm going to say that are there for what I anticipate to be some pretty choppy stock market environment throughout the rest of the year at least. One of those is a company called Market Access Holdings. It's a financial company.
Yes.
And it's a financial company that really, they are the leader in electronically trading bonds. So what happens when stock market goes wonky and people get scared? They go to bonds. Typically, what happens when there's a lot of volatility is that stock does pretty well. If I anticipate volatility, especially considering, it's an election year, that could increase volatility as well. I'm going with Market Access.
That's a good call, especially with volatility. I'm going to, some of these are long plays, some of these are a little more, again, since it's fictional money, I'm taking some chances.
That's right.
So this is for my communication services or telecommunication. Lionsgate Entertainment.
Okay.
So they're an entertainment. They make movies. They make television programs.
They have to be beat down right now.
They're beat down. But my thought is, as they've seen some success in going direct to digital release, I think there may be some movie companies that have been sitting on some movies, waiting for theaters to open up, that may go that route and still get a decent return.
Yeah.
And so, again, a play in it. I know movie theaters are opening back up. We'll see what happens. But we like Trolls World Tour did this, where they did it just direct to digital, and they had a pretty good success for it, for a follow-up movie. So that's where I'm going, seeing what happens there.
To continue with my defensive theme.
Mm-hmm. Defensive.
I am going to draft a materials company.
Okay.
And this materials company is called Newmont Corp.
Ooh.
NEM is the ticker, and they are a precious metals mining company.
Okay.
So if I anticipate volatility to be around, through the rest of the year at least, I anticipate that gold will probably be at least stable, if not favorable to a lot of people during this time. And when gold does well, the mining companies that generally, and this company does gold, silver, other things as well, but that should be a good, safe play if gold continues to go higher. So I think it's going to be, these are a couple speculative moves on some anticipated volatility. I'm hoping that some of the growthy names will kind of offset and we'll have a well-balanced portfolio going forward.
Sounds good. I like that. I'm going to go to healthcare. And in my healthcare sector, I'm doing Cooper Industries or Cooper Companies.
Cooper Companies. Tell me about Cooper.
COO. Cooper they have two sections. One is, think of like contact lenses. Yeah. They make the little contact lenses. And so that's a big piece of their revenue. They also do some international stuff for that as well. They also manufacture diagnostic and surgical stuff for gynecologists, including like preventative stuff. So they're in the healthcare side, but they're maybe some of the stuff that people have to have, like contact lenses. Regardless of COVID-19, if wherever I'm at, I still need to order my contact lenses. And so that's my plan in healthcare.
Okay. Yeah, I like it. So you've got 7, I've got 6 names down. My 7th pick is going to be Google. That's my communication services. I think that compared to the rest of FANG, they really have not done as well. They've done well, but they haven't done as well as the rest of FANG. And I think that there's going to be some mean reversion, and they could stand to do a little bit better than their competitors going forward. And I still feel like they are the king of search. That's huge. And they've got a lot of different things going on that I think could really benefit them going forward. So Google, I think that they have fantastic products, and I think that
they have a far superior mapping system than Apple Maps.
That is what people say, but I've never had a problem with Apple Maps.
But you just don't even know what you're missing.
That's true. I don't.
You don't get walked to the door and it opens for you by Google Maps. It's incredible.
It just knows.
It's ridiculous. That's a good call, though.
So Google.
All right. So I got 3 left. Looks like I have a couple sectors I need to choose from. So invest in what you know. And I know across the street is a energy company.
Yeah.
from where our office is, Marathon Petroleum.
Yep.
So I was looking at a couple energy options, and I thought, you know what? Energy in general has taken a beating this year, and actually part of last year as well. People are getting out driving more. I think we'll see at least get a little bit of recovery. That's the hope.
Yeah.
So it was between that and then a tanker company, which holds the stuff, and I was debating, but I like Marathon because they're the refining and the distribution side of things. So Marathon Petroleum.
Well, continuing with the energy theme, I also think that there's some opportunity there. Not that it definitely has risk too, because if we, for some reason, well, for COVID reason, had a bigger or longer or more extended continued shutdown or whatever, oil prices would for sure tank again.
Yep.
But I am with you too. I think that if that happens, it's going to be kind of limited to maybe areas or something like that. So we probably won't have a nationwide one. And I think that there is some opportunity in energy. That being said, I am drafting a company, ticker MMP, Magellan Midstream Partners.
I almost went with a limited partnership.
Yeah.
You get a nice dividend out of those.
So I get a 9% yield, which I'm going to get half. So I'm going to get 4.5% yield. It's a pipeline company, as most MLPs are in this industry. And I feel like they are actually, so while a lot of the bigger oil companies, for at least this year, are going to be losing money, this company is projected to continue to earn a profit amidst all of this. So I like that. I like profitability, and I think that with the combined effect of the hopefully increased demand, potential, probable profitability, and the decent yield, I think it's going to be a good play.
Good call. Good call. All right, down to the last two. This is one that I didn't know anything about. It's a basic materials company, and it's called Advancix. ASIX is the ticker. I looked up. But they do polymer resin. So that is in everything.
It's plastic.
Yeah, it's in everything.
Yeah.
I mean, they do it for engineered plastics, fibers, filaments. They do it in film. Automotives, electronics, carpets. That was a big one. So like when you think of like that Scotch Guard type of thing, that's that stain resistant carpet, sporting apparel, fishing nets, everything you think of, this stuff is in there. So from a material standpoint, it's being used a lot. So going that route.
I am going with an industrial myself, and I'm going with WD-40.
Oh, yes.
And this idea, I think it came from it was from one of the Ritholtz wealth management guys. I forget who posted an article, and they were like, hey, think WD-40 is boring? Let's look at the historical return since 2000.
It's crazy.
It's crazy.
Yes.
But it's something that you invest in what you know. I use WD-40 on everything. I think it smells amazing. I use it as cologne.
It does have a unique smell.
But really, I think that as things open up and manufacturing and industries continue to grow and people start working on things, that the demand is going to pick up for that product as well. So WD-40, ticker WDFC.
It should do well if we have a smooth, well-oiled economy.
That's right. It's a well-oiled economy.
All right. My last one is financial services. So what that meant, I left utilities out. For those keeping track. I'm going with investing in what you know. I know nothing about this company, but I do know the ticker is NOAH, NOAH. So
fair enough.
My oldest son, that's his name, so I know that, and so I'm buying that. But what it is, it's NOAH Holdings, and they are a wealth management firm that oversees a lot in China area. So as China is developing, you get more and more people with wealth. They do asset management, wealth management, financial planning over there. So, again, know nothing about this company, but I like the ticker, and I have a theory on well-named tickers, so I'm going that play.
Hey, that's okay. And my last pick 10 of 10, because you took my original REIT, I was going to get a utility instead, but I think utilities don't have enough growth for what I'm looking for in this environment.
For this play.
Yeah, so I am going to get a REIT myself.
Okay.
I'm going to invest in, with my hypothetical money, DLR, Digital Realty Trust. And that's it's a REIT, a real estate investment trust that focuses on data centers.
Yep.
And data centers are huge right now as we are in a world of big data, and all of the data on all of the internet has to be stored and transferred and moved around and manipulated somewhere. And where that happens is at data centers, which are pretty much big pieces of land with big buildings with a lot of air conditioners and a lot of supercomputers inside.
That's true.
And that demand's only growing.
Yep.
So, Digital Realty Trust is my last pick.
Sounds good. All right. So we got those written down. Austin's going to create a cool, awesome spreadsheet for him and I to track.
It's nerdy. It's cool.
And we'll do a podcast on this at the end of the year when we look at how we did. But after talking and getting those in, and I think in the show notes we can even put our 2 little draft picks so you can see them if we went too fast for you with the tickers and stuff. But we wanted to talk about, okay, this is fun, fantasy drafting, fake money. It's a good time. It's different than what we preach and talk about and how we're actually invested in real life.
Exactly.
So the first thing is diversification. And so this is 10 stocks, all in the U.S., traded on the exchange. You're not very diversified. Although we did choose 10 different sectors, you're still all equity, all U.S. equity.
Correct.
And very growth-oriented for the most part. So diversification, and Austin and I were talking about, I always like to say, if you're happy with everything in your portfolio, you're not diversified. Right. You should always be unhappy with something in your portfolio because that means they're not all moving in the same direction.
Because it's great when things go up at the same time.
If everything moves up, that's awesome. But that means they'll probably all move down together. Yeah. And so when it comes to diversification, the key there is you're spreading your risk out into things that don't all react to the same triggers. And so, easily from a high level, you got cash, you got fixed income, which are bonds, and then you have equity. They tend to be uncorrelated to each other. Big word, just meaning they don't do the same thing. Some are inversely. Yep. And so, I would say cash and bonds are probably a little more correlated to each other, but in general, they don't usually do the same thing as each other. And then when it comes to underneath those, so equities, you could have U.S., you could have international, you could have emerging market. There's all different types, large cap, small cap, growth, value.
Yep.
Being diversified, while if you are awesome and can pick the right things, diversification will mute your returns, but also mutes your volatility.
Correct.
And so what it does, it allows people to stay invested over the long run because they're not seeing the full extreme volatility of owning one stock and hoping it works out.
Right.
Or in our case, 10 stocks.
Yeah.
And so that's the first thing. The other thing, too, is we're talking 6 months, right? We're investing for now, and our goal is just to win in 6 months. Again, if that's your time horizon, stocks probably aren't your best choice because the 6 month window is a very volatile time. As we saw at the beginning of this year, this last 6 months were intense.
I would not have wanted to start this 6 months ago.
Yeah. And so, looking at that, we believe stocks are designed for long-term investing.
True.
Because if you look over the long run, the longer you own stocks, the higher your chances of having positive returns. And so we know that historically, the stocks are positive 3 out of every 4 years if you're looking at calendar years, but that 1 year's down.
Right.
And we don't know which of those years it's going to be. But the longer you go 5 years out, you have a higher probability. 10 years out, even more. 20 years out, there's never been a 20-year time frame that you've lost money in the stock market.
Yep.
So, the longer you hold stocks, the less volatile they are from a return standpoint. And so, again, we're having fun here. This is, it'll be fun to track. But from an actual investment standpoint, diversification is key. And then also your time horizon. Make sure your investments match your time horizon.
Yeah, and it's important to keep in mind that we're not using real money. So this is completely hypothetical money as much as I would like to just dish out $100,000 each to go have fun and invest in the market for this, that's not reality. Yes. So this is not real money.
There's names we picked for me, especially like Noah. I mean, that just there's just no reason I picked that because I found the ticker.
Well, exactly, and these are risks that we are able to take with money that's not real because of that.
Yeah.
So
if we go to zero, I did not lose any sleep.
Right. You lost a donut.
Yeah.
That's
and
okay.
even that, I'm going to buy 2. I'm going to eat one anyways.
That's right.
And so
we're
going to
be good. We're going to be good. So the market is really volatile, and we just need everyone to understand that there are risks and there are potential rewards, and balancing that risk-reward relationship is key. And just note that choosing one stock from 10 sectors, as we did, we could miss out on really good companies that are in that sector that we did not pick, or we could also miss out on really bad companies in that sector. And that's just the risk of being really not so diversified. You've got 10 names. 10 names is still a lot of your assets in one name.
Yep.
So, overall, keep a long-term goal and invest for the long term with a well-diversified portfolio, and you'll be able to sleep at night. Your financial advisor will thank you because they'll be able to sleep at night, and everyone wins. So that's the key. We're not necessarily doing this in real life. This is just an entertaining exercise, but in the real world, we're going to change things a little bit and keep a long-term horizon. But I think there are some things to consider when choosing stocks.
Before you do that, though,
before I do that,
let's do a dad joke.
Ooh, okay, yeah, this is about
All
to
right.
get serious.
People are probably getting ready to fall asleep, and let's wake them back up. Dad joke. So, crazy story. One of my kids swallowed a bunch of Scrabble tiles the other day.
Oh, I don't know. I kind of
Next time they go to the bathroom, that could spell disaster.
That's really gross.
Spell disaster.
But honestly, a lot of dogs eat those things.
Yep.
And
dogs eat just about everything.
That's gross. Okay, back to things to consider when choosing stocks. So this is kind of what people in our industry, a lot of people do. They pick stocks, and there's a couple things to look for when you're looking at particular companies. So number one, where are we in the economic cycle? Are we in an expansion? Are we in a contraction? Are we in a recession like we are right now? That's a good thing to know. So some names in certain industries are going to do well in recessions, and some names in industries are going to do well in times of expansion. So more like defensive, staple names are going to do well in a recessionary time. Discretionary names or things that people buy when they have extra money are going to do well in times of expansion. So that's something to think about. Also, really important to keep in mind, fundamentals drive the market over time. Over time is the key there because in a short term, the market can be all over the place. But fundamentals drive stock prices over time. So things to look for, are they growing revenue? Are they making a profit? Are they going to continue to grow revenue and make a profit going forward? Do you understand the catalysts that are driving that? Do they pay a dividend? And if so, is it a safe dividend that's not at threat of being cut? Or is it a growing dividend? Those are good things. Think about the industry that they're in. Are they giving up or taking market share? Do they have any competitive advantages? So those are all really good things to look at. But also try and look at the portfolio in total. Think about that diversified portfolio we talked about. Do you have exposure to multiple sectors that are going to be able to withstand different periods where certain sectors are better, certain sectors are worse, those kind of things. So kind of an overall gauge where you can get some ideas is, look at the overall. So for example, the S&P 500 market sector weightings as a percent of the total and see how the market, sees how things are going to move. And then you can adjust overweight sectors or underweight sectors from there based on your convictions on where you think things are going like that. You can even completely omit sectors, kind of like what we did. And this can be tough, and it really is honestly better done sometimes by a professional with a lot of fancy computers and a lot of research at their fingertips. But those are some things to look at that we look at when we're picking stocks and companies for our clients. And yeah, I think the key thing is that fundamentals are really important to understand. So if you don't really have a good grasp on specifically the statements that a company reports every quarter, at least here in the U.S., that would be an income statement, a balance sheet, and a cash flow statement. If you do not understand those, probably worth looking into. To watch some YouTube videos, and you can kind of get a good understanding on what's happening over time. So that is my 2 cents on stock picking in the real world.
Yeah, and that's a lot. So we just barely scratched the surface. Obviously, there's people that do this for a living, us included, and we're thinking, to do this successfully, you do need to spend the time to research and get a good understanding of what you're putting your money in.
Yep.
Because when you buy a stock, you're buying ownership in that company. You're betting on that company to do well. And so, if that's too much for you, that's why we always say a financial advisor can really help, because that's, same as wherever you work, you're an expert in your field because you spend your time day in and day out learning and becoming an expert there. That's what an advisor is for. They're there to continue to learn and educate on what's going on around them to help out their clients.
So thanks for taking the time to listen today. We hope it was entertaining and that you learned a little something. I guess we're just going to have to see who fared the best or perhaps the least bad.
Least worstest.
In December. But as always, check out our free gift to you. It's a brief list of 8 timeless principles of investing. These are overarching investment themes meant to keep you on track to meet your long-term goals. It's free on our website. Check it out.
So Austin, what else can they do? They can subscribe to our podcast. They can email us at hello@theinvesteddads. What else?
Yeah.
What do we need the most?
Also,
we need ideas,
we would love it if you would send us ideas for new episodes to that email address Josh just talked about, hello@theinvesteddads.com. Any questions, totally welcome. We're happy to reply, and we read every email that comes in. Also, if you could leave us a review on Apple Podcasts and share this episode if you enjoyed it with friends and family, we'd appreciate it.
All right. Thank you, guys.
Thanks.
We look forward to seeing how these stock picks do and talking with you next week.
Bye. Bye.
Thank you for listening to the Invested Dads podcast. This episode has ended, but your journey towards a better financial future doesn't have to. Head over to theinvesteddads.com to access all the links and resources mentioned in today's show. If you enjoyed this episode and we had a positive impact on your life, leave us a review, click subscribe, and don't miss the next episode. Josh Robb and Austin Wilson work for Hicks & Zerker Capital Management. All opinions expressed by Josh, Austin, or any podcast guests are solely their own opinions and do not reflect the opinions of Hicks & Zerker Capital Management. This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Hicks & Zerker Capital Management may maintain positions in the securities discussed in this podcast. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Past performance may not be indicative of future results. Indices are not available for direct investment. Any investor who attempts to mimic the performance of an index would incur fees and expenses which would reduce returns. Securities investing involves risk, including the potential for loss of principal. There is no assurance that any investment plan or strategy will be successful.